Hi, I'm Amal Khan and we're Group 17, and today we're going to talk about Chevron segmented financial information. Chevron got its start back in 1879 during an oil discovery at Pico Canyon north of Los Angeles, which was responsible for the formation of the Pacific Coast Oil Company. The Pacific Coast Oil Company soon became the Standard Oil Company of California and eventually became known as Chevron. Chevron is one of the world's leading integrated energy companies with subsidiaries conducting business around the world. They're involved in basically every aspect of the energy industry. Chevron explores for, produces, and transports crude oil and natural gas, refines, markets, and distributes transportation, fuels and lubricants, manufactures and sells petrochemical products, generates power and produces geothermal energy, provides energy efficiency solutions, and develops the energy resources of the future, including biofuels. Segmented statements are a type of financial reporting in which a company releases information by verifiable industry segments. For example, segments for a particular company can be things such as transportation, oil and gas, mining, and land. Companies can report revenues, income, assets, depreciation, and capital expenditures for each of their different operating segments. Segment reporting is required by the Securities and Exchange Commission in an effort to provide stockholders and the public with more accurate financial information. You can locate segmented statements by downloading the annual report of the company by either going to their website or looking at their 10-K forms. Once you have located the annual report, you should be able to find the segmented information in the Notes to Consolidated Financial Statements or other similar named section. Chevron reports the net income, assets, revenues, and income taxes for its operating segments. The segments are reported in two business segments, upstream and downstream, which represent the reportable segments and operating segments for the company. The operating segments show elements of the company that engage in activities such as from which revenues are earned and expenses are incurred, whose operating results are assessed on a regular basis by the chief operating decision maker, who makes decisions relating to the resources to be allocated to the segments and evaluates their performance, and for which discrete financial information is available. Chevron has two operating segments, the downstream and the upstream. The upstream operations consist primarily of exploring for, developing, and producing crude oil and natural gas, liquefaction, transportation, and regasification associated with liquefied natural gas, transporting crude oil by major international oil export pipelines, processing, transporting, storage, and marketing of natural gas and gas to liquids projects. Chevron's downstream operations consist primarily of refining of crude oil into petroleum products, marketing of crude oil and refined products, transporting of crude oil and refined products by pipeline, marine vessel, motor equipment, and rail car, and manufacturing and marketing of commodity petrochemicals, plastics for industrial uses, and fuel and lubricant additives. Now Ali will talk about the segmented earnings.
Okay. From the annual reports on the Chevron website, we now have the segmented earnings, assets, and revenues. All of these reports are separated into the two segments which Amul just discussed, the upstream and the downstream. Here for the earnings, the upstream total is $17,677 and the downstream is $2,478,000 with a total of $19,024. Same thing with assets. The total upstream is $120,242 and the total for the downstream is $41,965. Then the total here for the assets is $184,769. Lastly is the segmented sales and other operating revenue. The total upstream was $65,289 and the total downstream was $170,157 with a total of $198,198. Now looking at the two different segments calculated, we calculated the sales margin, capital turnover, and return on investment. The sales margin shows how much operating income the division earns on every dollar, so this term focuses on probability. The sales margin equation is operating income over sales. For upstream, we got 27% and downstream was 1%. The upstream is earning about 27 cents on each dollar, where the downstream is earning 1 cent per dollar of sales. So with this, the upstream segment's higher sales margin helps to account for its higher ROI. Next, the capital turnover is, it shows how efficiently a division uses its assets to generate sales, focusing on efficiency. To calculate this, it's sales over total assets. For the upstream, we got 0.45 times and downstream was 4.1 times. With this, the upstream segment is generating about 54 cents of sales for every dollar of assets, and the downstream segment is generating about $4.10 of sales for every dollar of assets. Therefore, the downstream segment is more efficient. Lastly is the return on investment. The return on investment measures the amount of income an investment center earns relative to the size of its assets. To calculate this, it's operating income over total assets. For the upstream, we got 15% and the downstream was 6%. Both of these ROIs are very low. However, the upstream segment has a higher ROI than the downstream segment does. Next, we are asked if we could calculate the residual income and or the economic value added. The residual income determines if the segment has generated any excess income above and beyond management's expectations. The RI includes the operating income as well as the total assets, therefore measuring the segment's probability and efficiency of using its assets. The economic value added, EVA, is an equation, a different type of RI equation. It looks at a segment's assets through the eyes of the company's stockholders. EVA is calculated by looking at three specific assets: the income available to stakeholders, the assets used to generate income for the stakeholders, and the minimum rate of return required by the stakeholders, referred to as weighted average cost of capital, WACC. So with the data that we are presented with, we are unable to determine the residual income and the economic value added due to not having the values of target rate of return of the WACC percent to analyze these calculations of each Chevron's operating segments. Now here's Alicia with the analysis.
The analysis is about internal reporting segments. Possible internal reporting segments are philanthropic, land drilling, ocean drilling, refinery, domestic gasoline sales, international gasoline sales, and franchising gasoline stations. Philanthropic is an important segment because it shows what is being given back to the community or how it is helping the community. The land and ocean drilling segments need to be kept track of closely because there needs to be awareness of where and how much drilling is being done. The refinery segment shows production rates as well as what events are taking place at the refinery. Domestic and international gasoline sales are important because they report the revenue coming from gasoline sales and from where it is coming. These two segments can also be compared against each other to see the difference between the two. Franchising gasoline stations shows where new franchises are being established, Another important aspect of this segment is that it can show which gas stations are profitable and which can help decide which ones to close and where to open new ones.